Hello and welcome to my morning note. The big question for asset allocation continues to be, are we about to see the great rotation that everybody has expected from bonds into equities? Are we seeing a move from favouring creditors to favouring debtors? Now, there are many arguments about this, but perhaps an even more important question is, if we do get this rotation, who is going to benefit the most? With me now to discuss this is the global strategist from Absolute Strategy Research here in London, David Bowers. David, thank you very much for being here this morning. Let's start out by looking at the ancien regime. Ever since the markets peaked in 2000, the green line there is the S&P. The way to make money apparently has been to pile into boring staple stocks or into companies that pay a high dividend.
Yes.
What's going on here?
Absolutely, John. I mean, you can see here just the sheer extent to which high quality, defensive, high yielding equities have been the place to be. And in a way, what all these have in common is that they are all equity bond proxies. They've all benefited from the secular bull market in US Treasuries.
Now, you have a chart to illustrate this. It all seems to be about bond yields.
This is even more dramatic. The blue line here shows how 10-year Treasury yields have been in a 30-year bull market. These yields have come all the way down, but the big relative winner, or one of the big relative winner, have been consumer staple stocks, perceived to be high quality, well-run companies, and that's the place you've wanted to be. You're absolutely right, John. There's a major call here, but I think it is to do with whether or not you think there is a shift in monetary regime, and a shift big enough to begin to cause people to question their default exposure to bond products.
Now, this particular chart suggests perhaps that rotation hasn't started yet, even if there might be some kind of a pause.
Absolutely, and we've been in a period of 4 years of chronic uncertainty, and people have been all the time working out what the next black swan is going to be. They feel like they've been managing money for the end of the world, for that next discontinuity. And I think the big question is whether central banks have done enough to take people from a world of uncertainty back to a world of risk, back to a world where the business cycle becomes important again, where the US consumer starts to revive, and whether bond investors stop thinking about central banks in a race to the bottom and start thinking about central banks as fundamentally changing priorities away from targeting inflation and looking after the creditor to an environment which starts to help.
Now let's take a look at this final really startling chart from ASR. What we're looking at here, as I understand it, the red line gives you what happens to tech stocks in the years of the bubble. And then the blue line gives you high quality relative to low quality stocks up until now. Does this begin to suggest that that we have seen the beginning of that turning point, the beginning of the rotation, when you start looking in the way stock markets play out?
I think when it comes to Europe, everybody knows that high quality has been the place to be for much of the last 3 to 4 years. I don't think people fully understand the extent to which high quality companies have outperformed low quality companies. And of course, some of the bank stocks are in that low quality segment. I think this chart is a really powerful warning, because when you do have periods of outperformance on this scale, as we saw with tech, when the regime changes, they're actually the last place you actually want to be going forward once the regime changes. And I think this is the big call at the moment, because despite the rally in equities in the last 3 months, we haven't really seen the bond market seriously rattled by really quite dramatic moves from the ECB, the BOJ, potential change at the Bank of England, and a Fed which is proudly proclaiming that it now wants to be behind the curve for the next 3 to 4 years. Last I heard, that wasn't good news for creditors and the securities around that. The big warning here is that many people have got very defensive portfolios even after this rally. And the equities they have are actually bond proxies. So they've got if you like, a double exposure to this change in regime. And I think people need to realise that perhaps being in high quality bond proxies equities is no diversification for the bonds that are on your asset allocation.
Okay, David, thank you very much indeed. Just to sum up, I think one of the lessons we learned from 07 and 08 is that you can have great diversification on paper, but in fact discover that you've made the same bet many times over. That may well also be true now in the stock market. one tentative play on the great rotation might be to start moving from high to low quality stocks now.